Warm good evening to all the participants. Emkay Investment Managers Limited is part of 26-year-old financial services group, and they cover over 260 stocks for research across 26 industries, handling over 8 billions in PMS and AIF assets. Today, we have two fund managers, Mr. Sachin Shah, with about 20 years of experience, who developed Emkay's proprietary module to evaluate and compare listed stocks on various aspects of governance. We also have Mr. Kashyap Javeri, fund manager with over a decade of experience, who has in-depth knowledge in variety of manufacturing and service sectors, along with banking and overall economics. Today, they will present Emkay's new Vitalized India Fund, which will invest in companies that benefit from strong rebound in industrial sector, export opportunities, and growth in services allied to industrial activities. I hand over the stage to Sachin, which will be followed by a question and answer session. Stage is yours, Sachin.
Thank you, Mr. Sivaram. Good evening, everyone. Thank you so much for being with us. It's indeed our pleasure and privilege to have all of you over here. Today, actually, we would like to present to you our latest strategy on the India's manufacturing sector. But before that, let me just give you a small brief about Emkay Group for a lot of people who might have joined recently. So, Emkay Global Financial Services is founded and promoted by two first-generation entrepreneurs, Mr. Krishna Kumar Karwa and Mr. Prakash Kacholia, both of them chartered accountants. They started this firm almost 25 years back, a little more than 25 years back, and they started this as an equity broking business, focusing more on the institutional broking side. And as an extension of the equity capital markets, we have also expanded into many businesses, whether it is commodities broking, investment banking, forex broking, and then of course, Emkay Investment Managers, which is where I and Kashyap are a part of it. So Emkay Investment Managers is more than a decade-old asset management arm of Emkay Global Financial Services. I have been with Emkay Investment Managers for more than 10 years now. We have strategies on the portfolio management side and also on the AIF side, category 3. In fact, we had our maiden AIF fund in 2018, Emkay Emerging Stars Fund, focused on small caps, which was followed with a very successful closing with Emkay Emerging Stars Fund 2 and 3 in the calendar year 2018 itself. We also launched our Emkay Emerging Stars Fund Series 4, and we are happy to say that we've closed that also very successfully, very recently. More importantly, we are very happy to announce that in the Emkay Emerging Stars Fund, which was a 5-year close-ended fund, we are in the last year, which is in the 5th year. And we've already started repaying or returning the capital and the investments and whatever profits that we've made on that fund to our investors. We've already returned more than 15% of the NAV, which is equivalent to 25% of the original capital. For this Emkay Emerging Stars Fund, we also have received an award from the PMS AIF World as the best post-COVID AIF performance. So, today we are talking about a new fund. Emkay, basically it's all about the manufacturing, right? So, in the last 5 years, the manufacturing sector actually has been a little bit of a slowed down because of multiple reasons. So be it because of the demonetization, be it because of GST, be it because of COVID. But the important thing is that during all this time, there has been quite a few undercurrents which are actually playing out very strongly for the re-emergence of this sector. So we strongly believe that the manufacturing sector today is at an inflection point, it's an idea whose time has come. And, as I mentioned earlier, that there has been a tough times in the last few years for the manufacturing sector. But, as they say, when the going gets tough, the tough gets going. And as we will see when Kashyap talks about in detail with a lot of data points, because, as they say, in God we trust, but for everything else, there is data, right? So, Kashyap will talk about how the manufacturing sector has actually created a very strong base for itself, and how certain undercurrents within that sector are playing out for it to actually accelerate even further over the next few years. Along with that, there have been quite a few catalysts, from the government side. And we also believe that there are certain trends on the consumption side, which are probably, clearly indicating that the manufacturing sector is probably going to take its place under the sun over the next 5 years. Yeah, Kashyap, please share your insights on this.
Sure. So, this particular slide, as we have put it here, we sort of call it Triveni Sangam, as we would call it in our, the ritual. So, there are three components of the ecosystem for the industrial growth, which we believe as of today are now converging at the right point. Like Sachin said, there is a manufacturer or an industrial, sector player who is now nursing himself, or rather has nursed himself back to health after going through a fairly long turbulent time, in last about 5 years. You have the government, which is supportive now, in a lot of ways. And, like what we call is return of prodigal son, the consumer who has been missing in action for last almost about 5 years. And let me try to put each and every of, these three components of the ecosystem in terms of data, how they have, bounced back. So if I look at the industrial sector over last about, let's say about 2-3 year period, what has happened is that if I look at as a manufacturer or as an industrial sector player, my cash return on capital employed today is one of the highest ever that I have seen in last almost about 14-year history. If as an industrial player or as a manufacturer, if I have an option to invest somewhere else today, my own business is today offering me the best of, the cash return on capital employed versus any comparable, investment avenue. For example, let's say if you look at bank deposit today, about a 3-year deposit will return something about 5.25%. And if you look at my cash return on capital employed today, it's almost as about 23%. So that gap is now the widest since that we have seen since 2004. If you recall, 2004 was previous start of the previous capex cycle, as we can, we would have seen in the history. Point number two, what has also happened is that over last about, let's say a 4-quarter period, which is post-COVID, we have seen capacity utilization across the board shooting up to almost about 70% plus. Also, the point to note over here is that within this 70% plus, if you look at a lot of organized player, the capacity utilizations are actually upwards of 85 to 90%. And when you look at the overall capacity utilization number, I think these are the players that I will look at, in terms of picking up of the capacity utilization rather than looking at the whole sector as such. What we have also seen post-COVID is that because, the consumption has bounced back with, vengeance, the order book across the board, if you look at the consumer goods, durables, if you look at capital goods companies, the order book is now growing at one of the highest pace that we have seen in last probably about just, about 6 or 7 years. What has also happened is that because this, cash return on capital employed and capacity utilizations have shot up meaningfully, manufacturing companies today are not, shying away from putting up more capacities. What I would call is that, now the manufacturing concerns are actually playing on front foot over here. So if you look at the registration of manufacturing companies within the overall register of companies data, that is one of the highest in last about 7 years, which means new manufacturing companies are getting registered almost every day in increasingly, increasing proportions. If I look at the overall, company registrations in India, within that, the manufacturing concerns being registered are today at one of the highest share at almost about 30%, number in terms of industrial, and almost about 20% plus in terms of manufacturing, which is again, one of the highest number that we have seen in last about 5 years. What also justifies this data or corroborates this data is the fact that if I look at environments, that environmental clearances granted are almost 10x of what we saw in CY15. Now, this is actually the start point of any capex, that, you know, whenever I want to put a capex, my first step to that capex will be A, I will buy land, and two, when I buy, after I buy land, you know, I have to go for environmental clearance before I put any civil structure for the next capex cycle. That number has also gone up by almost 10x in last about 5 to 6 year period or so. This makes us quite confident that, you know, the capacity utilizations which are seen in RBI data, and the fact that, you know, cash return on capital employed versus bank deposits, it's today one of the most favorable in terms of the manufacturing sector. The health, as we see over here, is you know, at one of its peak that we had seen actually way back in 2004. What has also happened, and I call this, you know, a sense of deja vu, because, you know, something like that we have seen even in the past, is that, you know, there are structural changes despite the turbulent period that we saw between 2016 to 2021 in terms of a lot of events that Sachin highlighted. You know, like he said, when going gets tough, tough gets going, right? So the whole industrial or manufacturing sector has used this period to, you know, get back in shape. Within that period, whatever the policies which came from the government point of view also have been supportive and you know, sort of rejuvenating the whole corporate or industrial sector. Just to give you a few examples, one, if you look at the corporate tax rate, came down from almost about 33% to 25%. Mind you that today, if I'm going to put up a new capacity, my tax rate will be actually just about 15%. If I look at the cost of debt today, has come down dramatically versus pre-COVID number. Obviously, we are going to be in a rising interest rate cycle, but still, having even accounted for that, the cost of debt would be significantly lower. What we have also seen is that, like I said, corporate balance sheets have been deleveraging. If I look at today, you know, Nifty 500 index, and if I look at the debt to equity ratio at gross level for those companies, it shot up to almost as about 57% pre-COVID. Today, that number has now come down to almost about 42%. If I look at the net debt to equity ratio, it's actually less than almost about 0.3x on net debt basis. So there has been significant corporate deleveraging which has happened. If I look at the other piece of the whole pie, which is, you know, who is going to fund this capex or who is going to fund this you know, consumption boom, the banks have also put themselves into shape. We have seen NPLs declining across the board despite COVID. What we have seen is that RBI has pushed a lot of banks to shore up the tier 1 capital ratios. And when this consumption bounces back and when this capex also bounces back, definitely we are going to see a lot of support from the financial system also. Now, if I look at the similar period which panned out between 1996 to 2002, 2003 to almost 2006 was the year when we had one of the best capex cycles, was one of the period when we had the best per capita GDP growth rate. Today, when I look at 2018 to 2021 and similar things panning out, which is cutting the tax rate, cutting the debt ratios, cutting the interest rates, what I do believe is that between 22 to 2026, what we are going to see is bounce back in the corporate, you know, capex, which is GFCF. What we are going to see is definitely growth in per capita GDP bouncing back, unlike what we have seen in last about 6 to 7 years. Besides, let's say, you know, I just spoke about whatever has happened in terms of, you know, what we could do endogenously, which is, you know, getting ourselves back to health. But benevolently, you know, the global systems or global economy has also been quite, you know, supportive of what we have been doing. So if you look at today, you know, there is a China plus one strategy across the board, which is gaining prominence. If I can give you some examples, there have been companies like Grindwell Norton, there have been companies like RHI Magnesita, there have been companies like ABB India, all these MNCs in their annual report for their global, you know, parents have been talking about the fact that they want to diversify from China. They want to keep Chinese capacities for supplies within the China, and for anything that they want to supply to the world, they want to put up new capacities in India. To the extent that companies like Grindwell Norton and RHI Magnesita have spoken about doubling the gross block in their Indian entities so that they can supply to the world. If I look at another factor which has also helped Indian, you know, exports being competitive versus Chinese, over last about 5-year period, what we have seen is that, you know, Indian rupee has marginally depreciated vis-a-vis the USD. So from going up from about 64 to about 76, but Chinese yuan compared to Indian INR has actually appreciated vis-a-vis the USD, and which has made Indian exports even more competitive versus, you know, the Chinese exports. The third thing which has happened in this particular space is that when the COVID stuck, the lock, unlock, and quite, you know, haphazard policies at the Chinese government level have also disrupted both the supply chains in terms of supply of goods from China and to the shipping lines also across the globe. And which is why, a lot of global corporates have become wary of, importing stuff from China, and they want to diversify. And this is not a phenomenon which is actually a recent phenomenon. If you look at the chart on the right hand side, in the chemical space, SRF, Navin Fluorine and Aarti Industries, which are one of the prominent companies in chemical segment, the exports have grown at about 15 to 18% CAGR over a period of last 5 years. If you recall, the global trade in last 5 years on overall basis is only contracted, and within which, if we have grown at 15 to 18%, our market share in the global market would have definitely gone up. If you look at two-wheelers and auto component industry, we have grown at about 10% and 12% respectively. Again, our market share in global exports would have gone up. If you look at machinery, which is capital goods, we have grown at about 12.5% CAGR over 2017 to 2022. Definitely our, share within the, overall exports would have gone up. If I look at also on the policy side, what has also happened on the export front as well as import indigenization front is that the government has become clearly supportive of us, something which is a deja vu of the days that, a government had started supporting services industry in 2000. So what we had was Section 10 AA, which gave a lot of tax benefits to the IT industry. Similarly, what we have today is, like I said, the tax cut which has happened for the new capex versus 33% tax that you were paying. Today, you have to pay only 15% tax rate. If I look at the PLI scheme as of today, there are total 2.4 trillion rupees of incentives which have been announced. Cumulatively, I think this is one number which has probably missed out the prominence in a lot of media articles also, is that this 2.4 trillion rupees of investments within, the industrial sector will cumulatively generate a revenue of almost about 39.6 trillion odd rupees over a block of 5 years, starting from 2023-24 onwards. If I break this up on per annum basis, that has capacity to add almost about 4% of GDP on annual basis every year. Assuming that we even achieve probably, half or 3/4 of this, targets that we have set for ourselves, that itself will, add almost about 2 to 3% of GDP on per annum basis. In terms of, let's say, we also, Sachin also highlighted that, the prodigal son, as we call it, the consumer, has made actually a comeback in the, quite vengeful ways, if I were to call it that ways in terms of consumption. So if I look at last about 5-year period, which is between 2017 to 2022, if you look at the per capita consumption expenditure, the growth rate dramatically decelerated versus what we had seen between 2008 to 2016. In fact, during COVID period, we grew at just about 4% on nominal terms. Couple of reasons for that. One, you had demonetization, which took away cash from people. You had GST, which also disrupted a lot of supply chains. You had COVID, which took away a lot of, livelihood from a lot of people. One of the very important point here to note is that last 7 years, we have seen complete lack of inflation also. If you look at the WPI number, WPI 7-year growth would have been probably in just about 1 to 2%. So at nominal, level, the per capita final consumption could not grow. If I look at today, we have made a vengeful bounce back. If I look at per capita GDP growth for FY22, at absolute number, we would in fact be now higher than again FY20 in terms of per capita GDP, which means that, over next about 5-year period, if we are going to grow our nominal GDP at about, just about 10 odd %, and the population growth will be probably just about 1.5 to 2%, our nominal GDP can grow back again at about 12 to 13% growth rate, like what we had seen in the past in 2008 to 2016. What it would do, and this is very interesting slide that, we take, go back every now and then. Let's say, for example, over a period of next 5 years, which is FY22 to FY27, the per capita GDP grows at about 12%. And I'm assuming inflation rate also going to about just about 4%, continue to go up, in that fashion. Let's say today, WagonR, which is a car which is one of the cheapest car available in the system. Today, I have to spend 4x of my income to buy that cheapest car. If my, per capita GDP is going to grow at about 12% for next 5 years, I will have to spend only about 2x of my income on buying one of the cheapest car in the system. If I were to today buy, let's say, one of the most expensive bike on the road, which is Royal Enfield 350cc, Today I have to spend about 1.5x of my per capita GDP to buy that particular bike. Over a period of next 5 years, I may have to spend just about 1x of my income. If I look at slightly cheaper goods and the goods which are more usable in day-to-day life, which is, let's say, for example, a television, and I'm today in here I'm being slightly lenient, I'm taking actually about 50-inch television. Today I have to spend almost about 40% of my income on this, versus that in 5 years I'll have to spend only 25%, and similar, so on and so forth, for air conditioner. So what this slide is trying to highlight over here is that if we continue on this path over next about 5 years, a lot of discretionary spends which today take away a lot of part of your income, they will be well within the reach of a lot of average Indians over a period of 5 years. So
Kashyap, so as you have rightly shown with a lot of data that clearly there are tailwinds for the manufacturing sector, be it because of the ground level current undercurrents that have been happening, because of the cash flow generation that has happened, the tightening of the belt that the manufacturing sector has done, because of the debt reduction and the discipline that they've got on the working capital side. Plus, we are seeing a lot of support from the government on the PLI side. China Plus One story is truly rocking and is no more a potential to my mind. It's actually happening because in our interaction with so many companies and the examples that you also spoke about from multinational companies, I think it's no more just the inquiries, but the inquiries are culminating into orders. And of course, on the consumption side, as you've very clearly displayed out here, that the data is supporting for higher and higher consumption. But this is just one side of the story, right? So there is always a 2-step forward, 1 step backward when it comes to India that we've seen all this while. So, if you could also highlight some risks and how do you think that some of this risk will actually get mitigated?
So obviously, like you said, nothing comes for free, right? There is always risk attached to everything. Without risk, there is no return. So there is a risk that one has to take when one is taking probably a bet on such a long-term and a fairly large paradigm shift as I have highlighted over here. But having said that, there is when you say that there is an idea whose time has come, and if its time has come, nothing can stop that idea actually. So in that sense, of course, there are risks, but I think there are a lot of ways that you can mitigate those risks as you go forward also. And there are 3 risks that we see over here, which are fairly large in nature. And they could, continue to be, I would not call hindrance, but they would be at the back of our minds as we go forward for next about 3 to 5 year, this journey. Some of them are, like I highlighted, there are 3 big and very large risks that I see over here. The first one is inflation risk. Today, what we are seeing is that base metal prices, oil prices across the board had risen because of the geopolitical risk in Q4 of last financial year. But if I look at the base metal prices over last about 15 to 20 days, there has been a significant correction of almost about 18 to 30% versus CY22 highs. And if I look at for current market prices for base metals versus even Q1 average for this calendar year, they are down by about 5 to 13%. Now, being a manufacturer, you can't wish away the risk. Obviously, the raw material prices, will probably continue to rise at much moderate pace than what we have seen today. But having said that, the way you would mitigate the risk is that you invest in the companies which have shown significant pricing power over last about many years. What we have also seen is that Nifty 200 manufacturing companies who have announced results till date for Q4 have actually seen a gross margin expansion of about 30 basis points on quarter-on-quarter basis, despite the fact that all the commodity prices have gone up in Q4, right? But they have shown that margin expansion at gross level also, which shows that when you look at quality Indian companies, they have been able to fairly in strong way able to manifest the pricing power, and that's what we will look for when we invest in the industrial sector, and that any investor should keep looking at. The second risk, which actually emanates from the inflation risk itself, is the interest rate risk and the liquidity risk, because if the inflation is going to go higher, neither RBI nor the central bank across the world are going to leave a lot of money on table for you to spend around. What I would say is that tightening of the balance sheets by global central banks is actually given. Having said that, if I look at particularly from India point of view, even after this 40 basis points increase in the CRR that the central bank has done in the last I would say mid-quarter monetary policy, the liquidity in the system is still going to be almost about 3.5% of the deposits still lying around. So we still have a lot of way to go before we see that liquidity risk emanating for Indian corporates as such. Point number two, when you invest in a lot of these companies, you should make sure that you invest in companies which are low on debt equity. Probably, if possible, you invest in companies which are net cash in nature. And in our portfolios, as we have been highlighting in our investment philosophy, that's something that we clearly stick to. The third point is that what if there is a global trade slowdown, because global central banks have been tightening rates, and obviously any tightening rates and liquidity across the globe probably will have some bearing on the the global trade also, and that might also slow down as we go forward. The way you would try, one would try to mitigate the risk is that, you invest in companies which are more local in nature. So you have a judicious mix of, companies in your portfolio, which are domestic flavored. Obviously, that's one point. And within that, if, there are companies for whom export is the market, and mind well, if I look at Indian companies as of today and within the global, context, our market share across the board in any commodity that you take, except for textile, we are not large players there. We have a lot of market share to actually chase away from Chinese players in terms of auto, in terms of auto ancillary, in terms of textiles, in terms of chemicals, in terms of electronics. Across the board, we are not such a large player that, global trade slow down and we do what we are doing as of today. We continue to do that in a fairly strong way, which is, keeping our health in steady position, keeping our consumer in steady position. There is a lot of market share that we can chase away from a lot of other players in the global parlance also. So I think
Kashyap,
you have all this risk, but you have mitigation policies also in place, which are available.
Yeah, sure, Kashyap. So that's very helpful, and it's very evident that you are very clear about how we are going to play this theme out and how will this theme actually play out. But as an investor, if I have to think about it today, one of the important things is that services businesses form a very large portion of today Indian equity markets, and rightly so, probably because today services as a percentage of the overall GDP is already 55%, and it has been growing quite fast over the last few years. But from all the points that you've highlighted, I think it's very clear that at least for the next 3 to 5 years, the manufacturing sector is going to accelerate quite a bit. So, as an investor, if I want to get an exposure, a pure manufacturing exposure, because today, if you look at the Nifty index, just the Nifty 50, or if you look at Nifty 500, or most of the other large indices, the services have a very, very heavy weights, right? It's almost 60%. Like BFSI, the banking financial services, will be almost 40%. 40%. You add another IT, will be another 15-20%. So this to itself, and of course, these sectors are great. But in the next few years, if we believe that manufacturing is probably going to take its place under the sun, then how does one really play this out? I'm sure at Emkay, we have actually thought through this, and if you can share some thoughts on that.
Sure. So, I will try to draw an anecdote over here, Sachin, in a sense that if you go back in the history, why services today has come to take such a prominent place in a lot of indices that we see, as of today. If you go back in history about, let's say, late, 90s, what we saw was a clear support from the government point of view for BFSI space, both from the, let's say, government policy point of view as well as RBI policy point of view. And obviously, I would say that, RBI policy, support would have been with some nudge or with some support from the government itself also. What we saw way back then was complete deregulation of interest rates year by year. First, you had to deregulate all the, savings rate accounts. Then you deregulated the whole term structure of the deposits in terms of term deposits. Then you deregulated all the rates which were on the lending side. Gradually, RBI came out with the policies where, banks could actually formulate the rates at which they are lending in terms of their own cost of funds. You had a lot of support from the government point of view by when they started raising capital in a lot of these PSU banks. You had a consumer who was ready to spend or rather consume a lot of these retail loans, right? So you had, what I called in the initial, remarks, that you had a Triveni Sangam, right? There also where you had a consumer, you had a government, and you had a bank. All these three came together to put the whole ecosystem in place. And what you see today, where in Nifty 40% weight belongs to banks, is actually outcome of that, the whole ecosystem coming into place. Going to IT now. If you go back in the history, government came out with a lot of these policies which supported IT exports, deregulation of all the foreign exchange, regulations. You had, complete freedom on the current account. At least today, we are not still current capital account free, but on current account, you had complete freedom to buy and sell FX. What you also did to announce, taxation in terms of Section 10 AA, where you provided a lot of freedom in terms of taxation to these companies. And today, what you are saying is that, even Nifty 50, even IT now occupies almost about 16-17% weight. So if you look at today, which is why this product that we have come out with, which we call ENVI, neighbors envy, India's pride, right? So this is going to be a pride of India, and neighbors envy. So what we have done over here is that there are 3 or 4 themes that we are going to capitalize on, which is, strong rebound in the industrial sector. What we are going to capitalize on is that, there will be a lot of companies who will indigenize a lot of import substitutes that we are importing as of today. We are going to capitalize on, export opportunities and Indian manufacturers supporting or supplying to the world. And what we are also going to capitalize is on, some of the growth in allied derivative one services, which may be like transportation or warehousing, so on and so forth. It's going to be a complete flexi-cap strategy that we are going to focus on over here. We are going to invest in all across market cap. We are going to be, across sectors. The stock weights over here are also going to be flexible. In line with what most of the strategies that we follow, we are going to keep it slightly concentrated portfolio in terms of 15 to 25 stocks, with a benchmark which is Nifty India manufacturing. So this is going to give you exposure only to the manufacturing space or industrial space in India. And like you said, there is a lot of, when you look at today in terms of Nifty 50 or Nifty 500, effectively what you're doing is, you're taking exposure only to the services segment, because if you look at today, almost 61% of Nifty 50, overall weightage actually is going to, only services segment. Within manufacturing also, it's very difficult to take exposure to actually quality manufacturing, because out of this 40%, you will have to still take exposure to commodities, metals, and, oil and gas, right? So effectively, when you are playing through Nifty 50 or Nifty 500, effectively what you're playing is, sort of services and probably not so quality corporate segment. But if I look at today, Nifty India, manufacturing index, it's fairly diversified portfolio one, because if you look at weights, which is on the right hand side, they are fairly diversified in terms of auto ancillary, cap goods. If you look at pharmaceutical, chemicals, all the sectors where you would want to, bet on if you're looking at India industrial sector rebound. And that's what we are going to do. Point number 2, how am I going to mitigate my risk further? The Nifty India manufacturing index beta vis-a-vis the broader market, which is Nifty 50 index, is actually is lower at just about 0.9. And if I look at the quality out of that, the beta of those stocks is just about 0.8, right? So what I'm going to mitigate is a lot of, stress on the portfolio, which might come from actually fluctuating Nifty also. Now that's on the risk part, right? So, this gives you exposure fair to the, where you want to be, and not necessarily only to the services. But having said that, I think what it also, increases is your odds of beating the market, which is this slide. So if I look at over a period of last 15 years, and break up that into 5-year period each, and look at my odds of beating the market, the chart on the bottom side, in the post GFC recovery period, which is 2007 to 2012 period, this particular index, which is S&P BSE manufacturing index, we have used this index over here for data purpose because there is a fairly long history available. For 55% of the days, it has been able to beat Nifty 50 on rolling 12-month basis. The odds of you beating Nifty 50, in fact, goes up if you look at the period between 12 to 17, where on 88% of the days, this particular index has beaten Nifty 50 in terms of trailing 12-month return. It's only during last 2017 to 2022, when you had a lot of this demonetization, GST, COVID, and so on and so forth, that the performance suffered. But like I said, we have used this 17 to 22 period to put a lot of things in place. If I look at in terms of returns, the chart on the right hand side top, this particular index has given 8.67% return between 2007 to 12, which is about 200 basis points higher returns versus Nifty 50. If I look at the period between 12 to 17, the returns have been almost about, again, 200 basis points higher. It's only in last about 5-year period, which have been quite turbulent, that that particular index has actually underperformed the overall Nifty 50 index. So one, your risk is fairly, diversified. You get the exposure that you want, and not, probably only exposure to services like what Nifty 50 and Nifty 500 does. And like I said, the odds of beating the market are also significantly higher over here. One of our group companies, has been running this particular, product on its own in past, which was Emkay Wealth India Manufacturing Small Case. And if you look at even last about 12-month period, that particular, small case has been able to outperform the broader market by almost twice. So if you look at the performance of Emkay Wealth, India Manufacturing Small Case versus India, Manufacturing Index on Nifty, the returns are almost 17% higher. If you look at versus, Nifty 50 also, or Nifty 500 also, there has been outperformance of almost about 17% there also. And if you look at last about 12 months, which have been very turbulent, or 15 months in terms of inflation, in terms of demand bounce back, in each of this period in 15 months, which is the bottom chart, that particular product has outperformed the underlying indices by a fair wide margin. But mind well, this product was run by one of our group sister concern. This has not been EIML product. All I'm trying to highlight over here is that the strength of manufacturing has already started reflecting in terms of indices returns. And I think, like you said, between next 3 to 5 years, this is going to just get more pronounced from here on. And particularly to talk about what is our prowess at EIML, Emkay Investment Managers, in terms of manufacturing. Some of the stocks that we have picked up in last about 10 years of our journey have been phenomenal return stocks for us also. For example, if I look at one stock which I want to highlight over here very clearly, and which we take a lot of pride in, which is Divi's Lab. We have been holding this stock for almost about 9 years now, and that's a fairly long period for any even long-term investor. And over a period of 9 years, we have generated a CAGR return of almost about 28% on this stock. The another stock we take a lot of pride in is Sundaram Fasteners. Again, we have held that stock particularly for almost about 6.5 odd years now, and the CAGR return on that particular stock is almost about 30%. If I look at some of the examples like Laurus Lab, when nobody was probably looking at some of this small cap company, we invested in them, we nurtured our investments, and today, if I look at Laurus Lab, today is now almost hitting a category of large cap stock as of today, and we have made phenomenal 100% CAGR returns in that particular stock also. So what I'm trying to sort of, if I were to capitulate this whole about the product that we are launching now, one, obviously it helps you to mitigate a lot of risk that you would take probably when you invest in broader indices. Point number two, there has been history in the past which shows that odds of beating larger market indices in this particular stock is fairly high. And point number three, if I look at the track record of one of our group companies as well as our track record, I would say the odds of beating market are actually in our favor, in that sense. So designing this product has been keeping in mind all these aspects to give you the best product available in the market.
Sure. Thanks, Kashyap. So clearly, as we can see here, that the manufacturing seems to be the next theme over the next 3 to 5 years. And for investors who would like to have a pure manufacturing investment portfolio, Emkay now has this new portfolio that we are launching, ENVI, as Kashyap mentioned. Theme is one part of our entire process, but over and above that, we have a very strong filtration and philosophy that I would like to talk about a little bit I'm sure for some of you, it might be a repeat, but in the interest of everyone, I would just like to talk about this a little bit. So at Emkay, we strongly believe in long-term investing. And as Kashyap already kind of showcased, that we've invested in so many businesses for a fairly long period of time, be it Divi's Lab, be it Sundaram Fasteners, be it ICICI Bank, be it HDFC Bank, be it Nesco, be it Mahindra Holidays, and I'm taking names across industries, across large caps, mid caps, small caps. So the point is that we strongly believe that investing is the game of compounding. The fun of investing is all about compounding, as Einstein mentioned, the eighth wonder of the world. The seventh wonder, eighth wonder of the world. And when we have to really be with businesses for a long period of time, it is very critical that we understand these businesses in and out. We have a lot of deep dive research because of that, and that's where we build our conviction, and that's where we are very patient going through good and bad times of the businesses. We are also a very focused portfolio. We generally have just about 20 odd stocks. 18 to 22 is our sweet spot. In fact, for our new product ENVI also, it will be a focused portfolio, just about 20 odd stocks. And one of the very important part of pillars of our investing philosophy has been that in investing, it's not about hitting a six, but it's about avoiding mistakes. If we avoid mistakes, we'll reach our goal, is something what we are very sure about. And to avoid those mistakes, we have our proprietary framework called E-Qual framework, which is MK qualitative framework, which is very much focused on the management quality. And obviously, when we talk about management quality, we look at multiple parameters, whether it's management integrity, management capability, wealth distribution to minority shareholders, investor communication, liquidity. The point I'm trying to make here is that although we will be very clearly focused on the manufacturing theme, in the background, whenever we are selecting businesses, we will make sure there are ticks in each of these boxes. How much ever great the business outlook may be, but we need the base, the fundamentals of that particular company, for that corporate, of that management to be in place for us to reap the benefits of the tailwind in that sector. So we will keep all of this in the background for sure. Yeah, so this is about the model, the E-Qual model, management integrity. This is a little bit more in detail, but I'll just share a couple of points out here where, how do we evaluate management integrity? So there are multiple parameters that we look at, whether it's promoter holding. Promoter holding has been increasing or decreasing over the last couple of years. What has been the equity history? If there's too much of dilution, we don't like that. Has the promoter holding been pledged significantly? We try to avoid those businesses. What is the promoter salary? If it's significantly higher, we believe it might be compromising minority shareholders' interest, or in case of multinational companies, it could be royalty, interparty transactions. That this is also a red flag for us, and also auditors. So, similarly, we will have parameters for management capability, for wealth distribution of minority shareholders. Say, for example, in wealth distribution to minority shareholders, we will have parameters like dividend distribution. We will have parameters like, has there been any large acquisition, or has there been investments in unrelated businesses, right? So some of these things really help us, avoid mistakes. So this is what I was talking about. These are certain red flags. If the promoter holding pledged is above 70%, we avoid investing in these businesses. We are very averse to debt equity of more than 2.5 times. In fact, as Kashyap mentioned earlier, most of the investments that we do are companies with either net cash, or they are very, very low debt. Again, I mentioned about a large acquisition. We try to avoid those businesses at least for the next 12 to 18 months till the acquisition is fully absorbed by the company. And then we would like to see whether is it playing out the way it was anticipated. This is the risk reward. So we are also very, very conscious about our purchase price, because as we strongly believe, everything is good at a price and everything is bad at a price. And as they always say, there are two certain things in the market. They always go up in the long term, and that's why we should remain invested in equities. But the other certain thing is also that they will go up and down both in the near to medium term. So if one has done their homework, and if one believes that this is at a good purchase price, then market definitely gives us an opportunity, particularly in the volatile times that we are going through at this point in time. Yeah. So these are again some of the other processes that we are very, very diligent about. We look at the track records, and within the track record, we are extremely focused about the cash flow side. We are extremely focused also about the opportunity size, because Indian economy is all about growth, and growth is a function of the opportunity size that is there in the industry structure. Inherent profitability. This is also very important, because the businesses need to generate significant amount of cash flows to reinvest for their future growth. Management quality, we already discussed about the management integrity side, but I think it's also very critical that management should have the right strategy, because they need to have the big picture, big vision on how they'll be able to capitalize the opportunity, and then of course executing it to the T. I also spoke about the purchase price discipline. So this is how we plan to build the entire manufacturing theme portfolio. We strongly believe the tailwinds are there. And as I mentioned earlier, we are at an inflection point, and it's an idea whose time has come. I think now we can probably open up for Q&A so that we have enough time for any important questions that we would like to take. Over to you, Mr. Sivaram.
Yeah, thank you, Sachin. And in fact, manufacturing growth is going to be benign. Government is willing to help. And Mr. Kashyap is an expert in banking also. The funding part he will definitely look at. It is an excellent presentation. And I will have plethora of questions have come. Both of you, anyone wants to take the questions, can take. The first question is, how the profit pool of industrial sector will change in the next 5 years versus last 5 years because of lots of tailwinds are happening now for the manufacturing sector.
So, Sivaram, I think
sorry, you need to be little fast because I have a lot of questions.
Sure. So quickly, let me put that in terms of numbers. So if I look at Nifty India Manufacturing Index, last about 5 years, if I look at the profitable companies in that particular index, the growth in earnings, if I look at 5-year CAGR, which is 2016 to 2021, has been roughly about 4%. These are only companies which were profitable since 2017. And if I look at generally the market consensus estimates, the same companies over next about 2-year period, the earnings growth expected between 2022 to 2024 is roughly about 30%. So that shows the strength that a lot of us are seeing in terms of what could be the earnings pool available over next about, let's say, 3 to 5 year period.
The next question is, there are a lot of supply side shocks now prevailing, and how it is going to help this theme in India in the future.
So like I showed in my presentation, a lot of the supply side shock have resulted actually in advantage to us, right? So when people saw, China locking, unlocking, again locking, then unlocking, now again locking, the shipping containers hoarding that, happened over last about 18-month period. I think a lot of we as a country, besides textiles, we have not seen a fairly large market shares coming to us in terms of global trade. And if you're going to play this right through, let's say, government support in terms of taxation, in terms of cost of capital being, brought down, I think there is a lot of market share that we can take away from global players due to this supply. I think in a way it's going to help us rather than, disrupt us over a longer period.
Well, and what can be the approximate contribution of PLI and China Plus Fund to the manufacturing? Anyone can take this question.
So I think in terms of numbers, like I showed in the presentation, this amount of incentives, which is about 2.4 trillion odd rupees, it has potential to add almost about 4% of GDP per annum once it starts giving out the output. A classic example would be mobile, where we were importing almost about 100% of our requirements some time ago. Today, if I look at component as well as the assembly of mobiles, we are more or less self-reliant, right? So this would be anybody's guess, that if once this fructifies, obviously our reliance on a lot of goods is going to come down dramatically, particularly auto ancillary, automobiles, pharma, chemical, and electronics. We are going to be the supplier to the world as we see next 3 to 5 years.
Mr. Sivaram, if you don't mind, there is one question that has come also to me, which is there any lock-in period for this particular strategy? So at this point in time, we do not have any lock-in period, is what I would like to answer. Thank you.
Nice. And inflation now is taking the margin in entire market, and how it affects the manufacturing, how inflation affects the margin expansion in a growing sector like manufacturing.
I keep referring back to data because, the proof of the pudding is, in eating it, right? So if I look at Q4 numbers for Nifty 200 manufacturing companies, we have actually shown almost about 30 basis points gross margin expansion on, on aggregate basis. There might be industries which would have seen some margin contraction, But if I look at some of the industries where we enjoy a lot of pricing power, which is, for example, in case of automobile, auto ancillary, in terms of chemicals, in terms of, let's say, even cement for that matter, we have actually seen gross margin expansion that happened in Q4 versus Q3. Having said that, obviously, one part is data. The second part is how you could imply this in your own investment strategy. And like I said, when we do our company selections, one of the thought process or one of the key variable that goes into that is you pick up the companies where pricing power is available. It might be delayed, but it can't be denied, right? So it might be delayed by a couple of months when you take those pricing actions, but eventually it has to, it has to come to you. To give you one other classic example over here, if you look at tire industry today, in cumulatively, they have taken almost about 20% price hike if I were to start from December 20 onwards. Even if you look at consumption of tires today in terms of replacement market, it's still growing at a fairly strong pace, right? So we as Indians have been able to digest those price hikes because income growth has been now there in place. And I think if you take care of that pricing power in the investments that you make, a lot of this risk you will mitigate by just doing that.
Interest rates are hardening now, and the central banks are squeezing the liquidity now. What impact it will have on the manufacturing sector per se?
Obviously, in terms of liquidity, like I said, in India, we would still have, even after this cash reserve ratio increase, which has happened from RBI, we would have ample liquidity, available to fund the capex requirement, or let's say the consumer loan requirement as we go down the line. Point number two here is that if you look at even deposit growth today, even after whatever has happened in terms of COVID, a lot of income being in jeopardy for a short period of time when the lockdowns happened. Today, India deposits with commercial banks is still growing at almost about 10% Y-on-Y. If you look at SIPs today, still contributing almost about 10,000 crore rupees a month in terms of retail financial savings. Because I would assume that SIP is all retail financial savings, which means that Indians as savers are back into action. We per se, I think liquidity risk for India should not be an issue. In terms of global parlance, I think even after the Fed accelerating the bond buyback, bond selling program and taking liquidity back in, there is still a lot of time to go before we start feeling the pinch of that contraction in Fed balance sheet also.
The companies thinks about capex expansion when the capacity utilization is at 70-80%, and 90% they will be ready for the next expansion. When do you think this will happen for the manufacturing per se in India?
So our estimates are that, if we continue to grow nominal sales at almost about 11-12% for next about 2 years, by FY24 on aggregate basis at industry level, we would be more or less near where, we want ourselves to be, which is that 85-90% threshold level. And mind well, no capex, no company will start announcing capex when we reach that 90% level, because if you're going to announce then, by the time you get the capacity, probably the demand might not have been there, right? So I think in that sense, what we are seeing today, capex announcements across the board, have already started happening, whether it's building material, whether it's, chemicals, whether it's automobile, auto ancillary, whether it's in terms of consumables used in, steel industry, cement industry, we have started seeing those announcements actually happening by now. Also, so I think I would say FY24 would be middle of FY24 when we will start hitting that sweet spot in terms of capacity utilization. Sachin, you were saying something.
Yeah, no, if I can add just that when we talk to some of our textile machinery companies, they are fully booked for next 2 years. So the textile manufacturing companies, the yarn manufacturers, the garment manufacturers are already seeing what Kashyap is saying, that they will need their plant and machinery up and running in the next 12 to 18 months. And that's why they're actually, booking their, booking their equipments right away. So most of the textile machinery companies have their order book full for the next 24 months.
Taking full advantage of the corporate tax cut, companies have reduced leverage to large extent. How it helps to build new capacity, which is very important to build a very big manufacturing case for India?
So, lower tax leaves a lot of money for you as an industry on table to reinvest in future capacities. Just to exemplify, let's say if my PBT margins are about 15%, about 20% lower tax means I can save almost about 3% of sales, which I can reinvest in, in my business. And that number is also reflecting in the cash return on capital employed chart that I showed in one of the slides earlier, that, because of a lot of these reasons, the cash return on capital employed has shot up substantially, which can be now reinvested in new capacities. It leaves a lot of money on table for me as an industrial, sector player. Sachin, you want to add?
Yeah, no, it's good. There's just one more question which has come to me, which the attendee is asking, that what is the minimum ticket size? So, basically this strategy is as per under the SEBI registered discretionary portfolio management services, and as per the SEBI regulations, the minimum ticket in size for the investments is rupees 50 lakhs.
Thanks, Sachin. Okay, and can we take the next?
Sure.
Yeah, sure.
This China plus one is a lot of big noises being made. In China, to change policy, it takes about only 12 people, no parliament, nothing, and they can change and they can go back to the original manufacturing themes. This China plus one advantage, do you think it is transitory or permanent to India?
So like I showed you in one of the slides, it's not something which has happened today, right? It's been happening for almost about 5 years now that we have been growing our exports in some of these key sectors at very rapid pace. And mind well, between this 5-year global trade would have not grown at all. In fact, it would have contracted probably for that matter. So I would not put myself or I don't see myself in a camp that, which says that just because China is pulling itself back, Indian exports are growing. They are growing on its own. There has been a lot of policy supports. There has been support from the currency point of view also. Mind well, for China to come back and people to trust those, supply chains again, by itself will take its own sweet time. We have proven to the world that we can supply whatever you want at the right price, at the right time. And I don't think today, if I look at most of these annual reports of global manufacturing companies, nobody is talking about whether we can get a low cost goods from somewhere. What they want is more clarity on supply chain. What they want is more ability to rely on the supply of goods, and that's what is driving us, right? Not necessarily the fact that China is pulling itself back.
And if I can add, and they also would like to have alternate sources. So which is where India has proven in most of these industries, be it textiles, be it chemicals, be it pharmaceuticals. In fact, we spoke about DVs, which is a classic example of that. Specialty chemicals, auto ancillaries. So these are industries where India is offering a very credible alternate for an second, third supplier to the world.
Preetham Dattich is asking this. 15% of corporate tax you mentioned for a new manufacturing company, is it eternal or for it is time bound?
No, this is time bound, so it will get over by the end of this financial year, if I'm not mistaken. But all I'm saying is that versus even 33% tax that you were paying earlier on, let's say, a normal corporate or maximum marginal tax rate, that number itself is down to 25, right? So it's about 8% cuts that we have seen.
And you made in your presentation, you mentioned 31.5% is for semiconductors. Still, it is in the nascent stage. When do you think it will fructify?
So when we spoke about that China plus one strategy and how global supply chains have forced people to look at the alternative channel, one of the classic example again here is semiconductor, and consequently another neighboring country which is Taiwan, right? So that's a classic example. If we are able to do this in the right fashion, I think that's going to take off very meaningfully well in next about 3 to 4 years. Unfortunately, we might not have a play over there because directly over there because in the listed space, a very handful of companies have applied over there, and we are not sure what structure they are going to use. So, but I think in next 3 to 4 years, we will see this happening. You see, we have replicated this whole strategy in IT, we have replicated in banking. It's just that the template we have picked up from there, and we are now applying that to manufacturing. So I think we will be successful there.
All this presentation ends with returns. Does this philosophy to blossom is to an investor return? What is the time frame an investor wants to know?
So for any equity strategy to make money for you, irrespective of the sector or the theme or the market cap that you're playing, we would say 3 years is the bare minimum that one has to have a patience for. In fact, in last 3 years, that even 3-year notion has been challenged quite a couple of times actually. So I think 3 years is the bare minimum, but I would say when this completely blooms out in a, let's say, if I were to call it that way, a full-fledged flower from the bud, I think it's 3 to 5 year that I'm looking at, from returns frame, time frame point of view.
Thank you, Sachin and Kashyap. And in fact, I found it a very unique strategy. I don't think any parallel is there in the market to the strategy, to my knowledge at least. With a disclaimer, I'm telling this. And it was a very nice presentation. Both have complemented each other. It has come out very well. I want to thank Sachin and Kashyap for a wonderful presentation. I want to thank the Paytm our strategic partners who have joined this call, along with all the investors. Thank you very much.
Thank you.
Thank you, Mr. Sivaram. Thank you, everyone, for attending this. And thank you, PMS Bazaar, for giving us this opportunity. Thank you, everyone.